Welcome to Orange County Power Players, where we spotlight the personal, professional, and financial success stories of OC's top leaders. Here's your host, Danny Flores.
Welcome back to OC Power Players, where I interview some of the most successful people in Orange County. I'm Danny Flores, your host, and today's honored guest is Jonathan Frank, zooming in from Corona. Welcome, Jonathan.
Thank you. Great to be with you, Danny. Appreciate the invite and excited to jump into it with you.
Yes. So you do equipment and leasing finance. Tell us a little bit for our audience what that is and how it works.
Absolutely. So I work for a firm that offers equipment financing and leasing products. So essentially being the finance institution behind those product offerings. At the end of the day, we're giving you guys access to capital for equipment that is needed. We also offer a working capital product as well, which isn't tied to any sort of equipment in any way, shape, or form. Kind of more of your just direct capital product. A blank check, use it for anything you'd like. Here's, $1 million, $2 million, $5 million, whatever the dollar amount might be. But our bread and butter is equipment leasing and financing. So coming to with business owners, they say, hey, I need 10 million in CapEx this year for my manufacturing plant or for my construction business, real estate development, whatever it is. We'll go out there. We'll be the capital source for you. Get that out for to the vendors on your behalf, and then you're financing that equipment from us through a variety of different product offerings. Your operating lease, capital lease, your strict loan product, whatever it is. But at the end of the day, we'll act as your capital source for these needs, and then get that equipment and items that you will need for your business for a monthly payment rather than some sort of large capital infusion that's typically needed.
Right. Now, if somebody's looking for equipment, do you help them find the equipment that they're looking for also?
Yeah, so we have a robust base in terms of vendors out in the marketplace. We also do partner with direct manufacturers, dealers, auction houses is a big one as well, providing financing for their customers as well. So we can absolutely go help you source equipment. But a lot of the times at the end of the day, it's customers coming out saying, I have equipment in mind, but I don't want to shell out $4 million for this piece of equipment or $2 million for this piece of equipment. Can I look at some financing options? Because I can hold on to some of that cash that I would initially be using and put it in other areas of my business, whether it be headcount increases or, other marginal things within the business that they could be spending cash on that'll help them grow in conjunction. So.
Right. And now what area, I know you're in Orange County, what areas do you cover?
So we service across the entire United States. Our corporate location is down in Tustin. So, and we're actually moving offices. I'm pretty excited here. We're just going to be down on Irvine Boulevard now. In a couple of weeks. So we bought the building. It's just going to be us down in there. We got about 120, 130 employees now within AFG. So we've been rapidly growing over the last 25 years. But in terms of our customer base, who we're servicing, customers all over the United States. And we have started doing some financing within Canada and as well as Mexico as well for U.S. based entities that have facilities or plants, manufacturing, expansionary capacities within Canada and Mexico as well. So it's something new we've rolled out in the last couple of years.
Wow. Well, that's, I guess you're accommodating the growth of your clients, right? Because
exactly.
They're growing and creating a footprint in Canada or in Mexico. They're going to need equipment there as well.
Mm-hmm.
Now, are they shipping the equipment from the States to Mexico and to Canada for something like this?
So it could be that. But most of the time we see is hey, it might be a non-US vendor, domestic based vendor. So a lot of manufacturing equipment is actually being produced. There's a lot in Italy that it's getting actually manufactured there. China is another big one where we've seen with the tariffs, obviously how that might be affected here moving forward. But there is a lot of U.S. production that's being done, and then the equipment will either get shipped into the U.S. or it will get shipped to Canada or Mexico from these other countries or from within the U.S. Another big one where we're seeing is actual acquisitions of other companies, right? Where a company will go and say, I want to buy the assets of this company. Can you help us out with that as well? They're within Tennessee. I want to start up this plant in California. I'm going to go buy that equipment. We need to get it shipped here, whatever it is. We'll include the shipping costs, the maintenance costs, all of that within the financing product for the customer. So it's a variety of different, things when it comes to shipping and logistics and all that nature.
Right.
But what we do is we work with the client directly to say, hey, what does it look like from the shipment aspect? What's the timeline on this? Let's make sure we're setting up, our offering to make sure we're working in cohesion with the vendor to get them the payments they need in time. Also potentially negotiating contracts on their behalf. We've had a lot where vendors, especially overseas vendors, will say, I want 100% of this, before we even ship the product. And it's a $2 million or $3 million asset. So, okay, well, let's hold our haunches here a little bit. Let's have a discussion on their behalf, take that consultative approach and say, let's work out some payment terms where, we're not coming out of pocket $3 million before the product is even shipped to the US. There has to be some sort of agreement we can come to. So we like to take that on behalf of our clients as well.
No, that's really good, because that way you can figure all that out for them and have everything, I guess, financed under one shot, I guess, at the time.
Exactly.
Now we know the biggest discussion right now is the tariffs. Is everybody rushing to buy equipment right now because they don't want to pay the higher price because of the tariffs? Or what does that look like in your end of the world?
So what we've seen is there's been a transition to the non-China based manufacturing elements, right? So a lot of our business is done within the US to other US companies, right? You have a lot of construction, a Caterpillar, Komatsu, these organizations or other dealers that are robust within the construction space or actually manufacture equipment here in the US. So that's a great spot. There's really been no change on that side of things, right? But there has been from overseas vendors. China's the big one, right? With where the tariffs have adversely affected the market the most. But your other vendors out of China and are still US based entities, there hasn't been much fluctuation in terms of price increases yet. So what we have seen though is rates, especially SOFR rates, have come down pretty significantly, which don't work. They work in conjunction with Prime, but they're not at the same rate that Prime is. So we've actually seen about a 70 basis point decrease just within the last, couple of months. So you have a lot of smart customers going out there saying, hey, my equipment is either coming from the US or it's not coming from China. I can lock in these pretty fantastic rates now. We'll see what happens in the next year or two, but I could structure it, in a way where I could potentially buy out in 2 years and then refinance again. So you have a lot of smart business owners and CFOs looking to move quickly right now due to the variety of things happening in the market that, hey, I can lock in now with a good equipment price. I'm not hit by tariffs yet, but I can get a little bit of a benefit on these rates, not going with my bank, going with an independent finance company such as, Alliance Funding Group, with who I work for.
So do you guys usually follow SOFR or Prime, let's say, margin for your interest rates? And maybe you can explain a little bit of that for our audience that doesn't know the difference between SOFR and Prime.
Absolutely, yeah. So SOFR, we base our lending off of SOFR rates, and the reason we do so is it's the more comfortable with when you come to equipment leasing and financing. It's the rate index that most non-traditional banks are using. Most banks will when they're lending off of other financial product offerings, they're using the prime rate because they can incorporate it in any sort of lending that they want, right? And a lot of the time what they're doing is actually having that be off of a variable rate where prime plus 100 and it'll then float with the prime rate. Rather than your SOFR rates, they're both federally published rates. You can find it on any treasury rate page that you'd look up, but it is based on a more traditional asset-based lending type of rate, right? So anything we do at Alliance Funding Group, and I know most lenders, in the marketplace that are large players such as ourselves are all doing fixed rate financing based off of SOFR. So I think prime right now is at 8.25 or around 8. I haven't looked it up today. But so far you're in the 3% range as of right now, on the mid to higher 3% range based off of the year. And we are still in an inverted yield curve. So when you're looking at a 5-year term, it is a little bit actually cheaper on that perspective to lend funds than it is on a 2 or a 3-year term, which is logically, that doesn't really make a ton of sense because your risk in a lower period of time would be less, right? But we have seen it minimize on that aspect of things, which is a great sign to see in the marketplace. It was very skewed over the last 3 years. And now we're seeing it come back to more of a normal spot and hopefully flipping the other way, which would be great, great for our customers. But those are kind of the two big differences. They both are federal rate indexes, but we are based off of SOFR, and you're getting a larger typical spread on SOFR. So say you have, SOFR right now, say it's at 3.6, right? I'm having a 200 or 300 basis point spread over that, which is going to get your client in that, 5, 6, 6.5% range on equipment financing, rather than your typical, line of credit product where I'm at 8.5 or 8.25, and then there's a spread on the bank of 50 to 100 basis points over that.
Right. No, that definitely seems like a lot more cost effective to be about 300 basis points less than the other line of credit type of product. And you said you guys usually lock them in on a fixed rate. So when they sign on the loan, that's it, regardless of the fluctuations after that.
Yeah. So upon delivery and acceptance of the equipment, right, you're locked in. So once the base term commences, so they say, hey, the customer says, I've accepted, product's been delivered. We then start the financing term based off of that, right? Because we want to make sure, obviously, the equipment is working to their liking and they're actually taking acceptance of the equipment.
Right.
At that point in time, yeah, you're locked in for the 5, 4, 3-year period, whatever term length you choose. It will not change no matter what happens based in the market, which is great for our clients setting that up. And it's a known qualitative or quantitative aspect of things. If I know this is going to be my payment every month moving forward, it's not going to change.
Right. Mm-hmm. Yeah, it definitely makes them and helps them allocate cash because it's predictable. It's a predictable payment every month, makes it easier for them to do whatever they need to do with that.
Exactly. Yeah, and then from an ROI perspective too, you say, hey, I'm getting this, use the number of 2 million again, for $15,000 a month or $30,000 a month, whatever the term length might be. What else? I used to have 100 and initially, right, I'm paying that first month. I have $970,000 left to go and use at my disposal. Let me plan out an ROI based off of what I could use this other cash for, or this equipment in itself might be bringing me in $50,000 a month. Well, my expense is only $30,000. I now have a $20,000, in the green initially from just getting the equipment in. And then I have all this other cash I can now use for other aspects of the business. So, It's a great tool. I think, data shows, 87 or 88% of companies in the US are using equipment leasing and financing in some aspect within their business. So it's definitely a valuable tool for companies to be looking at and evaluating at the very minimum.
Right. And like you said, you have cash. You can use the cash on other investments that'll produce greater return that way. Now, what industries are you seeing most activity right now?
Right now, construction is a big one. It's always great, great assets within that industry sector as well. They retain their value very well, so you're able to get some pretty awesome rates in the marketplace when you're evaluating those. And it's been a robust expansion in terms of what we've seen. A lot of our clients are growing at some pretty significant rates, looking to expand. A lot of contracts being won out there. And then another one is automation within logistics and as well as manufacturing facilities. So a lot of revamps of plants that are already out there. Also new builds within plants, but automating processes, whether it be specialized, lines or sorting equipment, things of that nature when it comes to the logistics side of things to make things much easier within the plant. Headcount, decreases, pretty significantly as well, but it just increases the efficiency of these organizations. And that equipment is pretty pricey at the end of the day when you're getting these builds, and they're long install times too. So that's where we'll come in and we'll say, hey, you don't have to worry about any capital. We're going to take care of any progress payments due to vendors. We'll take care of it all on your behalf. Those are the two big ones. And then healthcare is and always has been, a pretty strong industry segment, where your MRI machines, CT machines, hospital beds, things of that nature, a lot of hospitals are looking to finance those assets.
Right. No, that's good. I mean, now in the last 10 years, have you seen any difficult times where the economy has affected these companies from financing or going out and buying new equipment?
So COVID was a tough one in terms of just a lot of facilities shut down. You couldn't be around one another. So a lot of equipment wasn't being operated. And it made it really tough for businesses to go in and invest CapEx when they didn't know when their employees could be back and working with one another, right? That's the biggest one that I've seen. But the thing about equipment leasing and financing specifically, and the offerings that we provide our customers, is that at the end of the day, it really is recession proof due to the fact of in hard times, right? Cash is the most valuable. The old saying of cash is king. So, businesses are always trying to grow and equipment is always needed. So in tough times, holding on to the cash that you need or holding on to your main line of credit with your bank is paramount, right? So partnering with a company like us to go in and spend that capital on your behalf is incredibly valuable and important. The one tough time, though, I know it's saying it deals with recession proof. COVID was the one time where we took because nobody was able to operate the equipment at the end of the day. Right. Yeah, that was a tough time. We have seen some pretty significant industry shifts, though. Trucking and logistics used to be one that, was top three in terms of sectors that financing, easy to approve, deals getting done, and pretty safe. Bet, to put a lot of capital into is a good bucket to be financing within. We've seen a massive change to the downside on that side of things, where it's pretty tough to get trucking deals done right now, just due to a variety of different factors, within, obviously different regulatory laws within states and, changes to, different guidelines. But that was one of the industry sectors that used to be, an A+ industry sector. And now it's been a tougher one to get done over the last several years. So
does that mean there's a change in the industry and the way they move the product around, or just the regulations that are just making it tougher?
So at the end of the day, it's a risk management or, a way of looking at it. So that sector, due to a variety of different factors within changes within regulation, also default rates, also not really knowing, what's happening with, EV panouts and then, gas regulation, whatever it might be, makes it really tough to get comfortable with some of these credits. I mean, trucking used to be, you're usually getting A+ rates, strong collateral assets that you're looking at and looking to finance. And due to all of these different things that have happened over the last several years, it's made it very tough for, risk managers to look at this and get comfortable with some of the larger deals that we look at, right? When you're looking at your typical application only, hey, I sign a credit app and, I'm looking at assets under 500K, we're still able to get those done. We're mostly basing that off of payment histories of companies. But when you're looking at, large and mid-ticket deals of, I'm looking at stuff north of $2, $3, $4, $5, $10 million. Well, now I got to take a deep dive into all of the different things in the market with this specific industry sector. So that is one that it used to be very easy to get done, like clockwork. You're getting, 5 or 10 million. It was a great place to get an ROI on our capital. But now it's been typical. Defaults have gone up the roof. A lot of large logistics institutions that have a tough time over the last couple of years. So it's just one that we've seen a pretty massive flip. And then the other one, with robotics has come a large way into the better side of things, right? Where robotics used to be tougher, large installation times, vendors are really difficult to deal with. And now with all these US companies coming in, and we've had some great robotics companies in the US start manufacturing products, it's been one that's flipped the other way. So it's great to see.
Well, yeah, it's interesting how the industries change over time.
Exactly.
As demand changes also at the same time. Now we're in quarter 2 of 2025 already. what does the rest of the year look like for you? Any exciting plans?
Yeah, so we've had a lot of some pretty exciting, news within, or not news, pretty exciting, deal flow coming in on the technology side of things with data centers as this AI stuff has been, built out. A lot of these larger institutions are needing data center build out. So we've have a robust pipeline filled up for the last half of the year. My guys underneath me, all have, large 7-figure deals within that space. I'm working on a couple, north of $10 million deals right now that we've, signed term sheets on. We're looking to fund towards the latter part of this year. So that's been pretty exciting. And then it's really just getting an understanding as to, how at the end of this 90 days, how is tariffs going to play out? And then what's going to happen with rates, right? That's the biggest thing our clients are always asking us. And I wish I had a crystal ball on that, because I wouldn't be doing equipment leasing and financing. I'd just be trading every day within the market if I knew how that was going to play out. But that's the big thing is making sure, when we're getting information, we're passing it along to our clients, taking that consultative approach and saying, hey, this is where we're at now. Let's plan, accordingly over the next 3 months until the Fed has their next meeting, right? Or what do we think is going to happen over the next 6-month period of time, and discuss your guys' CapEx plans, what's important to you. And what also is just exciting from a macro sense is how much, investment is going in to companies in the US. Like Chobani just today released that they're building out another $1.2 billion facility within New York. So really exciting times for US companies expanding within the market and bringing some stuff over here, which is great to see. So.
Right. I think it's great for the economy and great for the workforce at the same time. So that's awesome to see that. Well, Jonathan, thank you so much for coming on and sharing your insight and what you do and equipment financing. If somebody's listening to us and wanted to get a hold of you, how could they do that?
So I'm very active on LinkedIn. You guys can look me up, Jonathan Frank, Alliance Funding Group on LinkedIn. Connect with me there. My email is another great way. Email is jfrank@afg.com. It's the acronym for Alliance Funding Group. So just first initial, the first name, last name, FRANK@afg.com. And then my cell is always a great way. That's on LinkedIn as well. So feel free to reach out to me there. I'm always available to hop on a call and discuss, and look forward to, if somebody found value from this today, reaching out and having a conversation.
Thank you so much once again, Jonathan. And to our audience, please go to ocpowerplayers.com and follow us on your favorite channel. Thank you, Jonathan.
Thank you so much, Danny. Appreciate it.
Thanks for listening to Orange County Power Players. Want to share your success story? Apply to be a guest at ocpowerplayers.com/guest.